By my own admission, I'm not the most talented investor in the world. I'm probably not even the most talented investor on my own street. The guy at number 42 looks like he is deep into CFDs. In order for this channel to be what I want it to be, a balanced and credible, trustworthy source for information, then I need to be able to sit here and discuss the times that I've taken an L with you. Because as Sam Smile says, we learn wisdom from failure much more than from success. We often discover what we'll do by finding out what we'll not do. And probably he who never makes a mistake never made a discovery. Well, if making bad choices counts as discovery, then I must be Manchester's Marco Polo. So here's 4 times that I have completely stacked it, starting with number 1. Neil Woodford's Equity Income Fund.
Protect your interests.
If you've watched this channel before, you've probably heard me mention Neil. But Neil Woodford lost billions in investor money, fled to Dorset, and ditched his wife for his secretary. Yeah, I'm not bitter. Woodford was a rock star investor at the time he launched his own investment fund. Described as the man who can't stop making money, or the British Warren Buffett. If you'd given him 10 grand in 1992, he would have turned it to 114,000 by 2012.
America! He is the Messiah!
So when Woodford said he was leaving Invesco to set up his own funds, it became front page news. HL promoted his funds heavily, and he was backed by St James's Place, leading to his funds actually being oversubscribed due to the amount of people who wanted to put money in. Me being one of those, I was lured by his track record as one of the best investors of our generation and all the media hype around his new funds. But there's a quote that goes, "Arrogance requires advertising, confidence speaks for itself." I absolutely love a quote. The heavy promotion of Woodford's new venture by HL was a nod to the arrogance that now consumed this man. We now know that retrospectively, he left Invesco because of arguments he was having internally about high-risk investment strategies that he was engaging in. He was buying companies that are not listed on the stock market, and these companies can be really hard to sell. So he went and set up by himself and bought a boatload of these types of companies with other people's money. What that meant was then that when people wanted to take their money out of the fund, he couldn't liquidate and get that cash to give to them. So then he eventually had to close the front doors on the fund, trapping people inside of it.
Not the Messiah! He's a very naughty boy!
It was actually the Kent County Council that caused the fund to shut down when they requested their 263 million quid back and Woodford couldn't give it to them. A lot of investors still can't get their money out to this day. It's so easy to blame everything on Woodford, and that is what the world did. The reality is the whole thing was pretty shady from start to finish, so if you are an investor that lost money in this scandal, don't kick yourself too hard. You had brokers like HL who promoted the fund even when they knew it was collapsing. You also have Link Group who were paid loads of cash to keep an eye on what Woodford was doing and just simply didn't. Or you even have the FCA, the UK regulator, who are still yet to hold anyone accountable for this mess, with Woodford still free to set up another fund if he wants to.
So again, I'm extremely sorry that we've had to take this decision.
This is why I'm such a big fan of investing in passive index funds and ETFs over actively managed funds. Actively managed funds have their place in the world, and Woodford's arrogance is rare amongst fund managers. But with an index fund, you're never going to wake up one day and think, well, thought I was buying the S&P 500, but it turns out I bought a load of unlisted medical stocks that I have no idea what they do. The total amount of money I lost here was about £1,500 and represented a 40% loss on my investment. Coming in at number 2 is my investment into the Jupiter India Fund.
Providing investors with long-term capital growth.
Right back when I first started investing, I had this idea that I wanted to invest in India. My logic was simple really. China had done pretty well, and India had a similar population to China, cheap labour costs, and an emerging middle class that were becoming more and more educated. I wanted to place a bet that India would do well over the next decade or 2. Now, I didn't have a Scooby about India or Indian companies, which led me to the Jupiter India Fund, run by Avinash Vazirani, which in 2009 and 2010 had an average rate of return of 53%. Okay, so here's a fund that seems to understand India pretty well. Who cares if there's a 1% fee when I can average 53% a year? Let's go.
Tell them to bring me my money.
What could possibly go wrong here? Bang! Minus 32% in a year. I sell out, get the hell out of Dodge, confused about what has just happened to me.
I can show you, if you pay attention to these patterns here, you can see on the graphs. I made these on my computer.
There's absolutely loads of mistakes to unpack here. The first being not understanding the market that I was investing in and its characteristics. Emerging markets tend to be a lot more volatile than Western markets. Just look at what's going on in China at the minute.
China, what do you make of the latest moves by regulators there?
I didn't understand that this was going to be a bumpy ride. I thought the ticket I bought was for the 50% gain train.
Yeah.
I also based expectations of future performance on past performance. And when it didn't go my way, I got spooked and I ran. I wanted to invest in India as a country, but at the time there was a lack of an availability of index funds that track the Indian market. So instead, I ended up buying into the investment philosophies of some bloke that I had no idea about. Lesson here is, know where your money's being invested in and understand the characteristics of that marketplace. Is it a volatile ride or is it a steady Eddie kind of investment? But most importantly, past performance means diddly squat when it comes to future performance. Just because something's done it before doesn't mean it's ever going to do it again. And number 3 is a quick one before we move on to the absolute clanger that I did in the last 12 months. This is simply selling my investments.
Sell it all today.
I've been investing for about 10 years, but at the start of that, whenever I built up a serious pot of cash or I'd made a win on an investment, something always seemed to come along that I could justify spending all that money on. Like 3 days in Ibiza with the boys, popping bottles of €20 Evian on the dance floor of Amnesia, celebrating how the holiday had been paid for by my investments. If only I hadn't sold. The market at the minute is basically at record highs. What that means in a nutshell is you could have bought any time in the past, any day you like, and if you'd held to now, you'd have been up. Any day. Lesson here is, don't tap out because you made a bit of cash, and don't spend your investments on stupid crap. Life is for living, memories over possessions and all of that, but I could have just saved up the extra money to go on holiday and kept my investments there working for me. The way I treat it now is, any money that goes into my ISA, that is not my cash. I can't touch that again. That's for future demos somewhere down the line. The poor bloke's inheriting a receding hairline and a gut, so the least I can do is tuck away a little bit of cash for him. Right, now to the main event. The worst investment I've made in the last 12 months. But first of all, a little bit of context. Before starting this channel, about 80 to 90% of everything I invested on a monthly basis went into passive index fund investing. Set it and forget it, long-term investing. The other 10 to 20% I would have a dabble with on individual companies, mainly focusing on tech businesses, financials like banks and insurance. I had a couple of REITs in there as well. The Tritax Big Box REIT stands out to me as one that's been really good to me. But when I started the channel, I found myself in a position where I was earning more money. I had my full-time job in which I've recently been promoted, and at the time in January, every single person in the world wanted to start investing. So I was doing pretty well out of Trading 212 affiliate link referrals and free trade and things like this. As I don't know how long this YouTube thing is going to last, I just save every penny that I receive from it. Well, I also do the giveaways. But yeah, I just save anything that comes in. Any free shares just stay on the app invested in the companies, unless it's a load of rubbish. I sell it and then buy other stuff with it. But I just keep the free shares on the app. At the same time, the market was going crazy with meme stocks.
How about GameStop? Continues to be one of the hottest stocks on Wall Street.
I was not working due to COVID, so I got bored and started taking more risk.
Okay, I'm bored in the house and I'm in the house bored.
Not with my main portfolio, I stayed disciplined there. This was with the money I was receiving from free shares. This was about the same time that we did the giveaway for £2,500. So yeah, as Drake would say, throwing hundreds when I should have been throwing ones. Now I did make some risky calls at the time that I did pretty well on. Argo Blockchain, Boohoo, Aviva, I did well on the recovery of tech stocks and well-established brands like Disney. We were having a great time. And then I discovered a business called Bidstack, who on paper, their product looks super cool. They have a piece of technology that allows you to place adverts inside of games.
That people can be in the same game at the same time, but see different targeted advertising.
The advertising within game sector is growing rapidly at the minute, at around 20% year on year, with gaming already being a bigger industry than music and film combined. So it would make sense that advertising within the space could eclipse that of other industries, which are far more developed within their product placement. News reports showed that Bidstack was bringing on new clients almost daily, and this was the only company within the in-game advertising space that you could buy on the market. So I did it. I slapped some money in at £5 a share, and over the next 2 months, my investment nearly trebled.
Oh my goodness. Yeah.
And since then, Bidstack has absolutely imploded all the way down to £2 a share. It is true that Bidstack has a great piece of tech and some very good partnerships with huge gaming companies. Their revenues are forecasted to grow 70% a year, but this little business is burning cash at an alarming rate. They only have enough money in the bank to keep the business going for 12 months, so will likely need to raise more capital. This is after they've already diluted shareholder positions down multiple times. Their losses have grown year on year, and I'm down about £500 on that investment, and now I'm firmly back in my box. The lesson here is around confidence and staying disciplined. It's so easy to stay disciplined when you haven't got much money. It's like when the end of the month comes and it's just before payday. You got £1 you feed yourself for a week. You get paid £200 on a Nando's. I was still investing consistently into index funds on a monthly basis, but because of this extra cash through the free shares, I fancied taking a dabble into the markets. I've made some gains in other areas, and I just got a bit careless and reckless basically, and it cost me 500 quid. The market at the time represented good value and there was a lot of deals to be had, but buying a business just because it has a good idea is not a good idea. Now, while the loss is embarrassing, I think every so often I need to remind myself of that point, and there's nothing better to do that than peeing 500 quid up the wall. Peter Lynch said, in this business, if you are good, you are right 6 times out of 10. Peter's a very gifted investor and he knows he's not perfect. I'm defo not perfect, and neither will you be. Acknowledge the times you make mistakes, the times you succumb to greed or FOMO, and learn from them. Or better yet, leave a comment below with your biggest investment mistakes. Absolutely no egos or shame in here, just put your biggest loss down for the gang to see, and we can all probably learn from each other. And we can also realise that no matter how much confidence someone talks with about investing, absolutely everyone has stacked it at some point, and they probably learned more from that than they ever did from the wins.
Look, I'm puffing smoke. Choo, choo.